Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Yeah, hey, welcome everyone to Vantage Point with True North Wealth Partners. I'm Andy Smith.
Eric Susie.
April 19th, 2022, episode 22.
22.
Hard to believe.
Really? I'm fast.
Yeah.
D-Day tax day. Woo!
That was fun.
Yeah. See, the highest amount of taxes that the IRS received, $2.1 trillion they've received, highest ever. That's what I heard yesterday. Mm-hmm. Lovely.
Yeah.
We paid our fair share, didn't we?
Feels like it.
Yeah.
Yes.
That's good.
Yep. But
Easter good? Everybody all right? Family?
Yeah.
Hanging in there?
Yeah, everybody's good. Trying to finish up the school year.
Yeah.
Time flies by, doesn't it?
All right.
Yeah.
Well, we got a lot to get into, don't we?
A lot going on.
Yes, sirree. All right. Let's hit it.
Start with some good news or bad news?
Let it roll.
Is there any good news?
Not much.
Crazy times for sure. Well, get some good news, I guess.
Yes.
The recovery, the slow growth, right?
Yeah, slow growth.
Housing's a bright spot.
Housing, yes.
Rates are up, but still low.
Yes. Up but low. That's true.
The participation rate's better. Mm-hmm. That's good. Yep. So those are some bright spots.
Amen. No, I hear you.
Yeah, we'll take them. Maybe you won't see so many. You start to see the signs disappear a little bit more from the McDonald's paying $25 an hour and things like that. So
yeah, no, I hear you. They pay well nowadays. We have a chart on wage inflation. So
yeah.
Being passed on to the end user, like I've been saying, right?
Yeah. Yeah. I did read something this morning, looking at the cost of living adjustment for Social Security that they bring in every year. They
higher or lower than last year?
They lined up with the consumer CPI.
Yeah.
So they're saying the highest since 1981 is what they're anticipating. 8.9% bump.
First rush, 8.9.
So if you're getting Social Security, that they're saying at least right now you might get around a 9% bump in pay because inflation.
They're going to need it. Yeah.
So
now it is finalized later. I think it's October, but at least this is first blush at it. So that's good.
Yeah.
Hey, people need it just to try to. Gosh.
And we'll see if they increase Medicare Part B premium by 9%.
9%. We're going to absorb it.
Yeah, crazy.
Yes, sir.
Anyhow, and if you live in California.
Our friend.
Yeah. Yeah, if you live in California, you might only be working 4 days a week.
4 days. Oh, yeah.
For the same pay.
Same pay.
It's 20% raise.
20% raise increase.
So.
Yeah, we reached out last week to our friend Ken out there in Sacramento.
Yeah.
So, hey, shout out to you, Kenny boy. But, he was like, it's pretty bad over there.
Yeah, so, we'll see if that makes it through there.
Yeah, hopefully not.
Yeah,
who knows out there?
Crazy.
Okay.
All right, what you got going on?
Oh, a lot. So, I'll try to not bore everybody, but you know me about stats and just numbers. But it is what it is. So I track everything on. Occasionally, I bring out the charts and share with you all. I'm just going to rattle it off this time. It's a little sometimes too much. So, fourth quarter GDP. Federal Reserve, Bank of Atlanta, GDP Nowcast just came out with today, 4/19/2022, with an update of 1.3% GDP first quarter Nowcast growth. So first quarter GDP growth rate of 1.3. It's up from the previous forecast of 1.1. So it's good. It was 0 at some point earlier, a few weeks ago. So, it is what it is. but it's definitely declining coming off the 6.5 GDP growth rates. So it just talked what you opened up with the show with. Things are slowing. Still no recession.
Yeah.
Feels like it. And we're still going to have that angst all year long, but no recession technically yet. And it could be later this year or early next year, things of that nature. But so that's just one point. Trading volume. So I track trading volume pretty much daily. And trading volume this year is 4.9 billion trades a day. That's up 9.9% versus last year of 4.4 billion trade per day. So again, 4.9 average year to date versus 4.4 last year. It's almost 10% increase in trading volume. However, what was the lowest trading volume days? Just take a guess.
What were they?
Yeah, what days?
I would say like Christmas Eve.
Close. Yeah, that's true. Yeah, that's a good point.
Days right before the summer.
Yep, that's does decrease. Okay, so you're spot on. So it was actually on last Wednesday. So Wednesday, 4/13 was 3.7 billion trades. Lowest trading volume of the year was last Wednesday. The second lowest trading volume was yesterday, 3.8 billion trades.
All right.
Second lowest. So
you did about 3 of those, didn't you?
Yeah. So I track this because it tells you as the markets start to curl, we're going to have some action going one way or the other. So just strap in, folks. It's coming. So that's that. So number 2, other points. I'm going to rattle off CPI. It's been 8.5% elevated as consumer price index, things of that nature. Some things are rolling over. Some things are still not. So 10-year. The 10-year right now, today, it's before I came in, it's at 2.92 is the yield. Yesterday's closing price was 2.86. So I have to go by the closing price was 2.86. But year to date, so 1/1 through 4/18, 2022, year to date on the 10-year, it's up 75.46%.
Yeah.
On the 10-year.
So when can we expect to see that settle down?
It will once we get deeper into a quad 4. As the markets churn over, then the fight to safety kicks in.
You see bonds rebound.
Bonds will rebound. That's correct. So that's what I'm anticipating, and based on everything I'm hearing and reading and all the calls we're on. Let's say the 30-year. 30-year closed yesterday at 2.95, and it's up 46.03% year to date. Okay, corn yesterday. Ding, ding, ding. Corn is the highest since September 2012 as of yesterday's closing price. So September 2012, it's 9 years. It's been 9 years since it's the highest close. 809.75. So $809.75 per bushel for corn. It's up 36.32% year to date. Again, up 36% year to date. Highest since 2012. Now, natty gas. You know what I mean? Natty gas. Darn it, Andy. Why didn't we just put everybody in natural gas? God, sorry, folks. It's just too volatile.
We have 40%.
Used to be the most volatile asset class. It's now Bitcoin, crypto stuff, and then natural gas. But anyways, so natural gas, and we'd had this discussion. Remember I was telling you. Dang it. Year to date, God, I hate saying this. It closed yesterday at $7.82 BTUs, yesterday's closing price, up 113.08%. 113%. Year to date, U.S. dollar. So U.S. dollar hit 100.80 at yesterday's closing price. So that's the highest year to date, and it's 4.73% up. So the dollar's risen. So that's great. And the bonds, the things are getting slackered by 8, 10, 12% down on fixed income. The dollar's strong. So that's a flight to safety.
Yep.
So gold's up, dollar's up,
Commodities
are up. So some of that.
And that's a standpoint.
Correct.
There's some commodities plays in there.
Yeah.
So
That's
which is good.
right.
So yep.
So we have you covered, but I just wanted to set the table on some stats of where things are at. Did you want anything else? Or want me to continue?
Well,
on?
no, I mean, I was just going to pick up, interest.
Yeah.
So, consumers, clients are probably thinking like, well, when, how come I go to the bank, right? I'm still getting 0.01% of my interest, right?
Banks never pass it on. They sit on it. That's the spread they bank on. But, as the Fed raises rates, so it's got to get into the Fed. So March, the Fed obviously stopped the bond buying, all the fake propped up the markets for 2 years, and created $9 trillion in balance sheet debt and all that stuff.
Yeah.
So anyways, they're going to now start raising rates, and they did, quarter point. Okay, great. Nothing here this month in April. The May meeting, there's a May, June, July meeting, 3 meetings back to back. Quarter, not. Right, Andy, we talked about a half at least. So they're probably going to do a half in May. Now, we'll see. Again, I and you, we've talked about this. There's talk now of 50-50-50.
Yeah.
So if they do 50-50-50 plus the quarter, so that's bucks at 1.75% increase in addition to.
That's big.
It's huge. So talk about reverse jets and soft landing.
Cut the rates.
They'll be cutting rates soon. So
We'll be back to low interest, right?
Yeah,
very low potentially.
Very rarely does the Fed do a soft landing. Typically, it pushes us into a recession at some point. But the other thing that the Fed's doing is just letting the balance sheet run off by $95 billion a month. Okay, so basically, it's going to be $60 billion of treasuries and $35 billion of mortgage-backed securities. So combined, that's $95 billion. So that's more than what it was in the last runoff a couple of years back. So, so my point is, long-term rates, they should be going higher because rates, they're going to be raising rates and they're letting the balance sheet run off. So that's going to induce like a double whammy. Mm-hmm. So this is going to be very challenging. So just want to at least point that out as far as what's going on there. Mm-hmm. I was on a call, Larry Williams, guy, this is on 4/15 this week here. Yeah, last week, whenever it was. The key, one of the key things is when interest rates start to go in reverse, what we just talked about, that's when you enter into a recession. So, the 2-year, 10-year is inverted, things of that nature. For a short period of time, it's now uninverted temporarily for now. But when it inverts and stays inverted for 10 days, that's a signal, obviously. But then once the Fed eventually reverses their interest rate policy,
lowering,
that's where you're going to be entering into the recession because typically it's a little bit, they're always late to the party anyways. But there's just some signs that he mentioned as well.
Yeah, and maybe the recession's not as deep or big or long, right? So maybe it's just kind of like because of the good things we talked about, right? It kind of helps buffer it maybe a little bit.
Yeah, I'm with you. And then nobody knows obviously how deep, how long, and all that. But the point is, when all eyes are on, hey, it's recessionary. Typically, you're not going to get into it that bad, So
they see it coming from a mile away, right?
Right. And this chart's really pretty cool. This is Hedgeye, one of the research partners that we use. So you'll see this on the chart here, but deflation is rare. Disinflation, not so much. So disinflation, you can see the points highlighted in gold yellow here. The difference between deflation is prices are falling year over year at a faster rate year over year. That's deflation. Mm-hmm. Disinflation is inflation slowing. So right now, inflation high watermark 8.5 last year. Again, but this year it could be in the 6 range, 6.25, 6.5. So parts are still going up, other parts are going down. But when you look at it year over year, things are slowing, and not everything is. So we're in a disinflationary period right now, where parts are still trying to slow and just eventually we'll get into a deflationary possibly. But right now it's disinflation. So this chart, there's 4 periods that are deflation, and there's 14 periods that are disinflation. So I just wanted to point that out. This is since 1948. It's a pretty interesting chart, just walking through the 2 differences of that. I'll just sort of rattle off a few charts, and then, you folks, you've seen all this before, but just give you some updates. So the volatility, the VIX index, okay, right now it's 22.2 through yesterday's closing price. Again, the average is 18.3. So again, times the volatility spikes up to the over 30 is the F bucket, between 20 and 30 is the chop bucket. Below 20, anybody can make money. So simple as that. Mm-hmm. Now, this is a little new chart, but Andy and I have been discussing bonds recently for the past few months here. But I want to show you the MOVE index, which is the volatility of the bond index. So it's called the MOVE index. And right now, it's right around 122. You can see the average is 81. So it has spiked up dramatically these past, let's call it month and a half. So that's why you're having issues in the bond market because of things are resetting, trying to adjust and plan out accordingly.
Buckle, you got to write it out, right?
Yeah, write it out. Yeah, that's for sure.
Yep.
Pullbacks. Remember we talked about, hey, we're going to have probably the average is 4.5. We're going to see that this year, and we're already at 3. So 5% pullbacks so far year to date, and 4 months into the year. So that's that. This is the interest rates, the 2-year, 10-year. Remember how, again, I mentioned the 10-year right now is 2.92. So this is yesterday, 2.85. But you can see the 2-year, 10-year, how it got rolled close and then it widened back out again. But you want to see that compared to the average. The 10-year average there for the 2.27 is on the 10-year. Right now it's basically 2.85 through yesterday's close. And then the 2-year is 0.88. And again, that really spiked up over 1,000%. Right now it's 2.46. So the real short end of the yield curve is taken on the chin as well. And then the interest rates as well, just talking about the difference on the 2-year, 10-year. The yield curve, talking about inverts. So you can see it briefly inverted just for like a couple of days only. Now it's widened back out to 0.39 as the basis points. That's the spreads widening back out. But you can see when it does invert, it goes into the columns, it's leading indicator into a recession. So whether it's 9 months, 12 months, a year and a half, but the point is it's something we're following, the 2-year, 10-year spread.
Was there whether there's a connection between the length of the inversion versus the like if it's like it was only a day or two, so it'd be interesting to see how that plays out down the road.
Yeah, you're right. But, yeah, so they don't technically it's 10 days. So again, I don't really it hit it, but it didn't it didn't start to clock yet. So it has to invert and stay inverted for 10 days, and then the clock starts.
Got it.
So to be pointed, good point on that. Mortgage rates. I know our man Nathan here, he's looking for a new home, but mortgage rates are over 5% right now, so you can see the spike up at the past month. Straight up, basically vertical. Not good. So with that, my brother at JP there, but never did 2 rounds of layoffs. More coming and dead.
Sure.
Sitting there going, what do I do in the morning?
No refis coming in.
Nothing, just dried up. Federal Reserve rate, remember they raised rates 1/4 basis point. This just shows a target rate where they want to go. So we'll see if they're going to get all their increases in this year. I highly doubt it. If they do, we're in a recession. Simple as that. We've talked about that.
Yeah.
Dot plot, again, this is where the members, this is the forecast where they anticipate them setting policy. Blue dots is their projections. This is quarter GDP growth. Okay, you can see fourth quarter was 6.9% last year, fourth quarter of 2021. First quarter this year, 1.3-ish. So somewhere you can see the big drop off. So everything's slowing. So the average is 2.8, and we're going to be well below the average for the first quarter, and we might get close to the average of 2.8 for the second quarter. But the party's over, basically, folks. So leading economic indicators. So I track this as well. So this is why we're pretty confident that there's no recession yet. Has to go negative, as you can see all this charts. But as it turns and leading economic indicators go negative, then that precedes a recession that follows. We're still at current as 119. So we're well above growth in the 8.9%. So we're monitoring that, the leading indicator. If it gets closer to 0, what have you, and if it goes negative, then obviously precursor for that. Wage inflation, wage growth, 6.7%, spike up. Hello. And the average is 2.9 since 2010, since 1990 to 2010 it's 3.3, but you can get the gist. So again, CPI, Consumer Price Index, talked about that, 8.5%. So that's elevated. It will still be elevated, but yes, coming down. Mm-hmm. So we don't see it getting as bad like the Carter years, but this is darn close. Oil and the dollar, this is pretty cool. It's a two-in-one graph. So the oil price, that's going to be on the left side, so you can see how it spiked up. $120 a barrel, came back down. So oil right now is about 108 roughly. I think it was around 104 today, but just as that. And the dollar, remember I talked about strong dollar, hit 100. There you go, ding, ding, ding. So that's the strongest since January 2020. So dollar's getting stronger, flight to safety. The good times, savings rate, to 30%. Flush government fake money, okay? It's all there.
Getting stimulus
gone.
money. Yep.
So the average is 6.8. Now the average is 6.3.
Yeah,
so
dropped.
people are below the historical average, all going back to 1990. So I heard recently half the population has only $500. That's it. So again, that's not good. So a lot of the spending will be curtailed. And then we talked briefly on commodities. Lumber came down over 40% last month. Lumber alone, straight down. Corn up, oil, what have you, copper, etc. So I just wanted to point out a few things. I know we covered a lot. Tips of the month, a few things there.
Yeah.
Excuse me.
So what? Yeah, you're an investor, right? You're sitting there going, okay, what's going? I'm diversified. I got stocks, I got bonds. Usually your bonds are kind of the safety or the buffer, right? And we haven't really seen that this year. No. So it's, but part of that is, like the alternatives.
Right, that's why we're into all this.
The merger arbitrage fund, the multi-asset fund, and then even some of those, but it's just riding some of that stuff out, right? The muni bonds of
time and space. Everything has a cycle to it, cycle pattern. So diversified portfolio works. And
stay invested.
We're adding alpha and staying. We've tweaked it and continue to tweak the models like we have been doing.
Yep.
So no, I'm with you. It's not fun, but it will get a little worse before it gets better, folks. So that's what's anticipated for the next few months.
We'll get through it.
We'll get through it. Yeah. I can't wait for November. Jeez.
Yeah.
Jeez. Please stop the madness.
So what you got? What's going on?
Tips of the month. Okay, so here we go. It's funny I lead right off of that to November, but anyways.
My student loan.
It's pushed off again, folks, because it's COVID. Yeah. It's been paused till November 1st, basically. So through, or August 31st.
Yeah.
So they're just trying to freeze it, whatever.
Yeah, I saw, Elizabeth Warren on the news about she pushing.
Of course.
That,
I have to have something to talk about.
Yeah.
God. Next is, stamps, United States Postal Service.
Does anybody use the Postal Service anymore?
Unfortunately, I still do once in a while. I'm learning. I'm doing more and more online like you. You do everything online. But so July 10th, stamps are going up to 60 cents, folks.
First class stamp?
First class stamp. So you got that coming. And this is pretty crazy. So again, this is James Grant's episodes that I get from him. So this is James Grant, dated Monday, April 4th. This is a little newsletter I receive. So just put things in perspective. This is about car prices. Domestic consumer coughed up, again, through him and Edmunds. Edmunds is the car company that puts all the numbers together. So domestic consumers coughed up an average of $648 a month for new car auto payments. $648 for new monthly auto car payments. Used cars are $538 a month during the first quarter of 2022. This data released by the Edmunds Show. The fresh records are both up 13% for new and up 24% for used, respectively, for the first 3 months since the first 3 months of 2021. So looking back a year, first 3 months to this year, up 13, up 24 for new and used. It's crazy. Yeah. 648 and 538.
Yeah, I can't imagine that. My rent when we got married was $500,
right.
But
I remember. Yeah,
$570 a month.
I was on the East Coast there in Delaware. I was paying $5 something, somewhere in the $5 range.
Yeah, we took our car to our mechanic before we went to Florida. We drove down. So I have a 2007 Honda Odyssey, and it's got almost 300,000 miles on it. And I'm thinking, I'm keeping this thing until my youngest son, who'll be in. My goal is to keep it until he graduates high school. Hopefully, my wife's not listening to this.
Yeah, sorry, Becky.
But I'm like, so I took it to the mechanic, and I need a new timing belt, a couple other things. He said normally, he's like, I'd probably say it's not worth it. He's like, but I've been recommending people do things to their cars I never thought I would because of that. Amen.
You know how we are. We drive cars till they fall off. So just maintain them, folks. And
they're horrible.
Now is not the time to be buying cars. So there's relief coming, supply. There's things that are happening. So it's not all bad news, but like I said, a few more months of pain. But all right, well, a lot there. I know it's a little technical, but we're all over it, doing the best we can. We'll continue to tweak things, massage. hang in there. Happy springtime. And
enjoy the warmer weather, hopefully this weekend. So
you too, Mr. Birdie Man.
That's right. A couple golf days.
All right. Good for you. Well deserved. All right, folks. Thank you. We appreciate you.
Thanks so much.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss.